Good morning. This is Josh Hayes of Hedge Plus, and here's the market monitor for Tuesday, July 29th. Well, we're still stuck in the pattern of no matter what type of good news we get from trade, no matter how strong exports are, and they are strong, um, nothing's really going to overcome good weather, the expectation of even higher yields, and the amount of product that's going to be coming to the market these next few months. Uh, Brazil has caught up quite a bit on their harvest. Argentina has lowered some export taxes on its own farmers. It will help them to be more competitive. I think what you're seeing is, while countries have not really had much choice but to work with the U.S. and sign these trade deals in order to keep the flow of their goods going, it doesn't stop other countries from swinging deals between each other and making adjustments. And that's kind of what you're seeing with Argentina here is they don't want to be left behind as the U.S. signs these trade deals. A lot of these commitments and trade deals don't have explicit requirements. It should definitely help the U.S. export more goods, including things like ethanol. In fact, the deal with the EU is very explicit in its some of its openings and commitments for increased ethanol purchases by the EU from the United States. But other countries aren't just going to sit back and just assume that they're going to start losing all of this exporting to the United States. They're making adjustments. So Argentina is making an adjustment, lowering their taxes on their exports to make their prices more affordable, and it's just it's competition. So uh, that's the one ugly side of trade deals and forcing these things. Which again, I'm very much in support of what we're doing. The balance was too great, but it definitely doesn't just stop there. Other countries make adjustments as well. We have uh, excellent exports right now. That should only increase. But right now, all that really matters is the good weather. There's talk that at our current estimated stocks to usage and our current prices, that the expectation by a lot of these models, and I know we had a model come out a few weeks ago that was very bearish as far as yields. Well, it's really apparently the model that these large funds are working with, and the model suggests that we're going to have a yield of around, or at least their expectation is a yield of around 187. Now, if that does not happen, and that might not be adjusted until January again, like last year, that's when you're going to see things tighten up. But based on a yield in the 186, 187 area, there's no concern that we're going to get tight. In the meantime, we are exporting a lot, and ethanol is one of the ways we're going to export more. Crush rates are very strong right now, and it's actually going to make things potentially quite tight before we have our harvest with soybeans. But we'll see. U.S. corn and soybean conditions are at such high level rate of ratings. Corn is best since 2016. Soybeans best since 2020. It's just going to be tough for anyone to come off of those uh, elevated yield projections. The USDA here in a couple of weeks will make their potentially their first adjustments to yield. That's the expectation. Hard to imagine them not making some adjustment at some point from the 181 area. And we'll see what they do, but last year, in spite of all the expectation that yields were going to climb as high as they did, while we set a record, we still didn't cross 180. So, will this be the year? That would be the expectation. But to jump all the way to 186, 187, that's hard to imagine, even though ratings are as good as they are. So, but regardless, right now, that's what the market's trading on, and that's why we continue to drift lower in the spite of what typically we would be very good news. This EU trade deal actually is a big deal. It does have some specifics. We are, you know, demand is strong. We're having good exports. We've had a weak dollar, and that's helped things more. The dollar is starting to strengthen. And unfortunately, the big one, the trade deal with China, is likely going to get kicked further down the road. It sounds like when they meet today, second day of meetings between the U.S. and China in Sweden, it sounds like the primary motivator for this meeting and objective is to set a meeting between Trump and Xi that won't come until the fall, and that's going to put off a deal with China, and that's going to put off any kind of market reaction. We saw very little market reaction, if any at all, to the deal with the EU. It now looks as though the only deal that would really move the market on its announcement alone would be something with China. Doesn't mean that these deals that have come are not going to have an impact, as they are, but it's going to be something that it's going to take some time to show up, and it's gonna have to overcome the idea that we're going to have this massive 185 to 187 yield. Taking a look at the weather, this is only going to help to continue the current bearish atmosphere. Cooler temps now, ample rainfall. Rain has never really been in down. In fact, if anything, there's some places that have probably gotten too much. But while we had that hot weather, we didn't have a rally because the rainfall was there, and that continues to be the case as temperatures subside. With cooler temps will become more moderate rainfalls. All in all, not considered an issue at all. U.S. weather is considered very good and is expected to continue to maintain these high crop ratings and put us on pace for record yields. Elsewhere, not too much around the world of any concern. The most concerning spot would continue to be Canada and the prairies. They're very dry, and it's adding to crop stress, but that has not done a whole lot to help the market or put any of their supply to the world market in doubt. Wheat is still considered an ample world supply. So even though things might get a little dicey in Canada, it's not expected to threaten the world supply situation. One of the reasons being Australia, they are getting good rains, the best rains they've had since April. Their crops getting better because of that. Other small issue in China, east central areas are again in need of rain, but nothing to cause any kind of concern or panic in the markets at this time. Taking a look at overnight prices, mixed bag. Wheat down about 6, but the big thing here is going back to our last market monitor on Thursday, about 4 trading days ago. Corn is down about 6 from then, soybeans down about 16, and wheat down about 13. This is a slide that we expect to continue for a while. How could you not? As you see that strong exports and trade deals and seemingly very bullish factors are occurring in the market, but the market continues to drift down, and that's strictly on the good weather and the amount of crop that's expected to come to the market. Currently, from South America, that glut still hasn't come to the point where their prices drop below ours. And then we'll have obviously our own crop as well. So we expect things to continue to drift down as they typically do this time of year. And it'll be a slow climb back up the hill into early next year if this is anything like last year. That's all for today. Tomorrow we'll have our grain gauntlet released, 5 questions about the grain markets. Another episode of Market Monitor on Thursday, and then at the end of the week we'll have Jason's Feedlot Focus on Friday. Hope everyone has a great day, and we'll talk to you again tomorrow.